is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Paul Martin with Investor Connect. Today we're here with Steve Diggle, founder of Vulpes Investment Management. Steve, thank you for joining us.
Nice to meet you all.
So where are you calling from today?
I'm in the countryside in Italy, in Umbria. I've got a country house here. I spent most of the summer here. It's 32, what's that in your, it's like 90 degrees and sunny. So that's why we like to hang out here.
That's great. So let's kick right into it. You know, your evolution from hedge fund pioneer at Artradis to founder of Vulpes Investment Management, what prompted the shift toward a family office model?
Well, I think people who've heard of Artradis almost certainly know it in the context of The Big Short. We were the most successful and largest people involved in that trade in Asia. My partner, Richard McGiddies, and I have been in Asia for 7-8 years, specifically running Artradis, and before that, at least a decade before. So that was our specific area of expertise. But we were running a fund that was significantly long volatility and short credit globally, but with an emphasis on Asia at a time when things started to become seriously rocky. And we were fortunate enough to be able to exploit that opportunity. We made about $3 billion for our investors over the 14 months between August 2007 and 2008. And that was a time when an awful lot of people were losing an awful lot of money, but we managed to make it. And also, most importantly, collect it and distribute it to our investors. And that made us certainly the most successful hedge fund in Asia in 2008. Most of them were clobbered. And in fact, because a lot of them halved and we doubled, we became briefly the largest hedge fund in Asia, which is kind of unusual because we were a niche strategy. But that's how people came to hear about Artradis, more than just being very specific investors in Asian hedge fund strategies. The challenge that was represented to the partners at Artradis was, how do you top a year in which you've made that amount of money for your investors in an environment that's very likely to be unique? So what happened in 2009, 2010, it became increasingly obvious to us that the amount of money printing that was going on by central banks, because it had been huge in the latter part of 2008, but it just carried on into 2009. And the more liquidity that was around, the less volatility we're going to see, because those two things are always kind of linked. You get spikes in volatility when liquidity dries up, particularly when you get forced redemptions and margin calls and so on. So if there's a superabundance of liquidity, you're not going to see big spikes in volatility. And our strategy was very much focused around that. So by 2010, we decided that if we carried on doing what we were doing, we were going to lose the gains that we'd made for our investors. So we actually decided to shut the fund in the third quarter of 2010 and actually physically shut it and returned all the money in February 2011. And my partner actually retired. So, I had to think what else I might do. I thought I was too young to retire. My partner was the same age. He had a different perspective. Good luck to him. He was probably the smarter one of the two of us. So we pivoted to doing quite a few other things. I mean, broadly, we would classify ourselves as a private equity, venture capital, and illiquid investor. And that's where we've been focused for the last 14 years. And we've done some interesting things. Some of them have been successful, some of them haven't. But I think overall, we've been busy. However, late in 2024, my partners and I started to get seriously concerned about some things that were going on in capital markets. And after the election of Donald Trump on November the 5th, 2024, we became increasingly convinced that there were numerous catalysts for more volatility. Volatility having basically been pretty depressed for a long period of time, and in a fantastically long, successful US bull market. And so we decided early in 2025 to reopen those volatility funds that we had closed in February 2011. And that's attracted a fair bit of attention because people are, I think, either curious or skeptical or, interested in why we would have done that, having been away from these markets for such a long time. So that's what we're doing now. Now, we are still specifically, or we're not a family office. A lot of people think we are, but strictly speaking, we never gave up our licenses. So we've been a regulated financial money manager out of Singapore, for 20 years, and we're still licensed to do that. We have co-investment from quite a few other, I think it's about 60 other family office and ultra high net worth. So we're not just a family office. We describe ourselves as a family office backed investment manager. Now, it's true that virtually all of our investors are either my own family office or other family offices, but we are no less an institutional grade money manager. So, that's us. That's where we are right now. And we're starting to expand what we're doing on this long volatility short credit side again.
So Vulpes has built a reputation around tail risk strategies. Can you explain what that means and how you see the role in today's market?
Yeah, the term tails comes from a statistical model that most people might remember from high school maths, which is there's a thing called a standard distribution or Gaussian distribution. That's the thing of like shoe sizes that goes up. There's there's like a bell curve. And as it turns out, many things in life have that. There's a standard deviation. Most people are in the middle. Most people have neither tiny feet nor huge feet. Most people are neither midgets nor giants. Most people have average intelligence, and there's outliers on both sides. And it turns out that that's pretty much the case in financial markets. Most of the time, things are normal. Occasionally, things go haywire, partly because of the way financial markets work, where you get really big moves in markets, not necessarily in stocks, but in markets, it tends to be skewed on the downside. Like, so, when I first started out in finance, we had this big move in October 1987. Stocks fell 20% in a day. It was a huge move. Stocks never rise 20% in a day in a market like the US. So what these things are known as the tails, because they're the extreme distributions. And tail risk specifically means what happens if you have a very big move. Now, for the vast majority of investors, that means what happens if you have a big move on the downside. It inevitably means that people are going to lose money generally, because obviously far more people are long than they are short. But if you have a tail risk strategy, you at least have one of your asset allocations that's making a lot of money, whilst the rest of your portfolios, getting affected. So tail risk is about finding cheap downside hedges where the seller has incorrectly calculated the probability of losing money. Because the thing about these tails is when they pay off really big, because most of the time, bad things don't happen. But when they do, you make a lot of money. So they'll give you probably our best ever example when we were traders is, we used to hedge the exposure we had to quite a few of our investment banks who were our counterparties in the trading we were doing. And that included the Lehman Brothers. I actually used to work at Lehman Brothers. It was my last paying job before I went out on my own in 2002. And having worked there, we always felt we needed a bit of a hedge because I was never entirely convinced that they were on top of their risk management. So we owned credit default swaps on Lehman Brothers. And what that meant was if Lehman Brothers ever went bust, someone else would have to pay us. Now, we were buying those credit default swaps for like 24 cents for every $100. So that's what people wanted to basically insure the credit of Lehman Brothers, essentially a quarter of a percent. Now, when Lehman went bust in September 2008, those bonds went from A- on the Friday to D on the Monday, and not surprisingly, the debt collapsed. By November 2008, those senior bonds, were trading like 10 cents in the dollar, and when they went to an auction on the credit default swaps, they settled at $91.62. So we bought this thing for 24 cents and we got $91.62. That's pretty much it's like 400 times our money. So, the guys on the other side had been paid 24 cents. and they lost $91.62. And obviously didn't do it on just $1. They did it on, in fact, hundreds of millions of dollars. So that's what tail risk is. It's finding ways that are going to pay off big if you have an unexpected and probably chaotic move in markets. And that's what we do. That's what we've always done. We've carried on doing it in a much smaller way for the last 10 years, but we feel right now that the risk reward is shifting back in favor of the buyer of these things, because markets have had a very good run. We haven't really had any bad weather for a long time. We had a bad couple of months during COVID, but then the Fed came to everyone's rescue. We had a bad 72 hours this year in April, and then Donald Trump came to everyone's rescue. But, we just feel the market has moved into a level of complacency where, once again, these things now look like something that, at the very least, people with big exposures to the market should be thinking about again.
Right. Well, so how did the 2008 financial crisis shape your investment philosophy? It seemed like you already had that before you got there, but maybe it impacted it. And what lessons from that time still apply in, say, the current global landscape?
Well, I think that, that everyone assumed because we were making a lot of money, and certainly the numbers said we were, they just imagined we were like the only guys in town who were like having a great time, and that we were all like high-fiving each other and laughing our socks off. It's very far from that. It was actually a terrifying time because, apart from the fact I had a lot of friends who were losing their jobs, I still knew a lot of people at Lehman Brothers who, pretty much lost their life savings. So it was anything but a jolly time. But even when you're on the right side, what we realized was the financial system had walked itself into an incredibly fragile state. I mean, I don't want to name names, but we were trying to collect on some of these bets of ours, and the investment banks were simply saying, "We're not going to pay you. See you in court." So, for a while there, it looked like we might actually, make $3 billion on paper, but then not be able to collect any of it. So we became very focused on having something that you can, that you can touch. And after, we did, in fact, collect all that money, including, we were big investors in our own fund. And we got we had a performance fee on our fund, like a lot of hedge fund managers. And the first thing I did is go out and buy things that I felt were going to be like really good investments, almost whatever happened. So I went and bought a bunch of farms, and whatever happens, people still need to eat. I went and bought a whole bunch of, affordable property in a bunch of places, because whatever happens, people still need to live somewhere. And, I went and, bought some gold, which had actually fallen in 2008. So the first thing I did with some of my own money is, insure myself on the downside, so that, I felt that whatever happened, I wouldn't be, destitute, which is what I was seeing to quite a few of my friends on the, my career long friends in finance. So that was one thing. But I think, we want to emphasize that the changes that have been made now in the financial system means that the risks in markets are not in banks anymore. Banks have become in some ways pretty boring investments again, right? They're almost like, almost become like utilities. So the big risk in the system in 2007, 2008 was in the banks. Clearly, it's not there now. So you don't want to draw the wrong lesson. I wouldn't be taking my money out of the bank. I think most banks are financially strong right now. But I think the big lesson you learned from 2008 is that markets change, investments change, but people don't. People don't change. They're ruled by fear and greed. They always want to believe things are going to work out well. If they go through a sustained period where things are working out well, they start upgrading their confidence. The phenomena, it used to be called bull market geniuses. Everyone's a genius in a bull market.
Right.
And what we're seeing now, and it's because it's a long time ago, 2008, an awful lot of people who are in the markets weren't around in 2008. So they may have studied it. They can maybe see it on a chart, but they didn't live through it. So, memories fade. Inevitably, people always want to believe that the things they're buying or speculating on is going to make them, money. And and if things don't go badly for a long time, you get this level of complacency creeping back in. And the biggest lesson I I would take from 2008 is what I feel now is we're in this period of maximum complacency because, it's very easy to remember, with things like the movies, the 2000, the movie, the Big Short it's a really good example. The number of people who are actually saying, there's some risks out there, people should be concerned about it. Things that maybe are not as good as they look. We were not only a very small number of people, but we were pariahs. I mean, no one was inviting us to speak at a conference because no one wanted to be here. The guy was going to go, well, maybe things aren't so great. In fact, maybe things are actually, a little bit fragile. So, once again, we are, people who are, we're not outrightly bearish. It's important to say that. What we're saying is that we feel that there are many things in the markets now that rhyme with 2008 and should be worrying people. And the thing that most of all rhymes is investor confidence, investor complacency, and an almost active willingness to not listen to anyone who's suggesting that things are going to get, could get worse and indeed a lot worse. So I think more than anything else, that's the lesson I would take from 2008.
So you invested across asset classes, from biotech to agriculture to frontier markets. How do you balance diversification with deep conviction?
That's a really good question. Diversification is a great financial risk management tool. But if you're going to diversify, you need to have what I would call true diversification rather than false diversification. You can invest in 40 different crypto coins, right? But you're not actually diversified. You're a bit diversified, but you're not really diversified. If you invest in 15 different emerging market debt, you have some diversity, but you're not really diversified. So, I used to work at Solomon Brothers back in the day, and some of my ex-colleagues went on and formed long-term capital management. Now, that was a very, very successful organization for a long time. When they hit the wall in the 90s, they had like 10,000 different instruments in their portfolio, but all of them were the same, right? They all moved the same way. Wow. So, diversification, you need to have assets which are either uncorrelated to have true diversification, or negatively correlated, which is one of the advantages of tail risk, or minimal positive correlation. I'll give you a very good example, Hall, which is gold. Now, gold's a tricky investment. It's really, people either love it or they hate it. But one of the things that it does do over time is it doesn't correlate with a lot of other things. Now, people believe it's a hedge against inflation, and over 4 millennia, it's actually been pretty good at that. But it's also, it's generally a pretty good hedge against instability, but it's not a bulletproof one. So the general correlation of gold in your portfolio is not necessarily that it'll go up a lot if everything else comes falling down, but it might not actually be correlated. 2008 was a bit of an exception because actually gold fell in 2008. It's always worth remembering that. But generally speaking, gold is a good example of a genuine diversifier in the portfolio. Land also tends to be an excellent diversifier. And one of the most interesting, and I can get a bit nerdy on this, but I think it's important, one of the most interesting roles right now is to what extent does bonds, specifically government bonds, specifically US government bonds, act as a negative correlation on your equity holdings? Because over a very long period in history, that's proven to be the case. It's led to this belief in this so-called 60-40 model. You have 60% of your money in equities, you have 40% in debt. You basically never go wrong. And it's historically been a phenomenally successful strategy. It's looked after people really, really well. And in 2008, even when things like gold were going down, those government bonds did really well, particularly longer dated ones. I think we may be in a really important moment in history now where that relationship breaks down. In 1945, the US government had debt to GDP of 120%, just having won the World War for everyone. Thanks very much. You're a little late, but you made a big difference when you turned up. But by 1973, that number was down to 23%, because that's what you should do, right? You run your debt up when you've got to save the world for democracy and freedom, and then you pay it down in peace and prosperity. Well, now it's 125 and heading north. And so, the role in which, the hegemon, the global hegemon, which is the US, and absolutely the dominant economy, military, government, whatever, everything in the world, the role to which those bonds have played as a stabilizing influence in people's portfolios, not just Americans, but globally, it has been a rock solid foundation of all diversification for like 80 years. Yeah. But at some point, you start to undermine that, that safe haven by having such a high level of debt to GDP that you can't maintain that. Now, I'm not the only person talking about this. People have been talking about this for quite a while. But, in the last election, neither party was really focusing on the issue. Both parties wanted to increase the deficit. The Republicans are doing it through essentially extending the previous tax cuts and not cutting spending. The Democrats just wanted to keep on spending, which they'd done, to my mind, at least a little bit recklessly. And I think an awful lot of that spending was why inflation hit a 50-year high in the summer of 2022. But I don't want to get off the subject. But, I think the role of US government debt in a diversified portfolio needs to be questioned, despite the fact that it's been an outstanding diversifier in the last 80 years, because the creditworthiness of the United States has diminished. From 23% to 125%, probably almost certainly heading for 130%, is a huge difference. And at some point, and you can never predict when it's going to be, at some point, the confidence in that bond market is going to wobble. And I don't know when it happens. Nobody can tell you, because it's a psychological thing. Confidence is a psychological thing. It's not, you can't model it, but it's a big risk there. And it could really play, just turn, haywire, the core asset allocations in people's 401ks and in a lot of pension funds and in a lot of, big institutional investors' asset allocation. And so from that point of view, I think you need to revisit your diversification assumptions and probably be more broadly diversified, I believe, right now than possibly you've needed to be, because that 60-40 rule has worked so well for so long that you didn't really need to think about going off into weird places and trying to find out about highly eccentric and idiosyncratic assets, because, like I say, that core exposure is just looked after you very well. Might not in the next crisis.
Could be. And so what trends are you most closely watching in volatility, defense innovation, and capital markets evolution in the next decade?
Well, look, I think there's one thing that more than anything else that worries me, which is that people don't have hedges now. So I think that there's a growing level of one-sidedness to markets. And this is potentially a big catalyst for volatility. We may have gotten a little hint of that in those first 3 days in April. And, what's been happening for years now, even a couple of decades, Hall, is, passive investing's been growing because it's been doing really well, right? In the last 10 years, your return on the S&P has been 260%. That's pretty fabulous. There's been even a couple of down years. It's looked after you really well. So given everything's kind of gone up and some of the things that have done the best, like the Magnificent Seven, have looked kind of expensive. So the people who have done really well, have been these passive guys. They don't charge you high fees. They don't try and guess trends. They just go and buy everything when you give them a check. And that's worked really well. So passive's getting bigger and bigger and bigger. But by definition, that means that active is getting smaller and smaller and smaller. Now, what active managers do is they follow this Buffett rule, which is, they buy when things are cheap, or when they consider things to be cheap, and they sell it when they get expensive. Passive doesn't do that. They just buy everything, and the highest weights is the thing they buy the most. So when things get more expensive, they buy more of them. So what stops a market falling is when you get fundamental investors coming in and saying, this is the bottom. It happened in March 2009 when the S&P was at 666, because, fundamental investors felt, we're on a PE of whatever, 9, 10, 11, that's cheap enough. But when you get an imbalance, and then passive, which when markets are down and when things are falling, particularly when people are putting in redemptions, they just sell everything. They just sell everything. And at some point, passive's going to get so big that if that starts to happen, it's just going to swamp fundamental value investors. So the chances that we get this big imbalance in markets and that algos, which are very significantly momentum driven, are selling, that passive of its nature is selling everything, and that fundamental investors just don't have the firepower to stop things overshooting. I think that's becoming a really big risk. And we saw it once in my career before, which was back in 1987 when I was just starting out as a derivative trader. Once again, actually, funny enough, at Lehman Brothers. Lehman Brothers was both my first and last job in paid finance. But there was this phenomenon called portfolio insurance. Now, it's ancient history, but people should go and look up what happened. And what these clever guys from an organization called Leyland O'Brien Rubenstein, that were really successful, they said, you don't need to go off and buy things like put options to insure your portfolio. Don't do that because they're expensive and most of the time they expire worthless since you just lost your money. We'll do something else. We'll dynamically hedge your portfolio, which means if futures markets start, if the S&P futures market starts, because all futures in those days, if the S&P futures market starts coming off, we'll dynamically short futures to hedge your portfolio. And that'll save you a ton of money because we'll only be selling when markets are weak, when you only need the insurance. You won't have to waste all this money by buying these put options to insure your portfolio. When things are good and you won't need it. And it was a popular strategy, and it became more and more popular and became more and more popular. And what happened is the scale of this reached a point that when in October, things started to significantly sell off, these guys just waded into the futures market and were selling what at the time was enormous numbers of futures contracts. So it just, every time the market tried to stabilize, it swamped them. And it swamped them again. And that's why we ended up down 20% on that day in October 19th, 1987. It was just an imbalance of markets. There was nothing really wrong fundamentally with the markets at the time. I mean, they subsequently rallied pretty strongly in 88 and 89 and then, onto new highs. But we had this imbalance. And I think the risks of an imbalance right now are way greater even than then. So in terms of volatility, we think, the downside tails are much too cheap because the chances that something in this massive, vast, multi-$100 billion engine goes wrong and that we get this imbalance in liquidity, which means we can't stop a fall in the markets. We just keep falling because every time we try and stabilize, the robots just keep selling. I think that's a real risk. And it's one of the reasons why we're back with this strategy and emphasizing that, big investors with big allocations to markets might want to think about some non-dynamic hedging because, if you look at the way multi-strat hedge funds operate, now they've been phenomenally successful. I mean, they've made the people who run them some of the richest men in the world, and good luck to them. They've been delivering great returns, but they do pretty much the same thing, Hall, right? They don't have a whole lot of tail risk. They don't have a lot of out of the money stuff. What they do is when one of those pods, because they divide these hundreds, scores of billions of dollars, sometimes more, and they're all levered. When one of those pods hits a stop loss, they just go to cash, right? You get liquidated. And in fact, you lose your job as well. And, that's proven to be a great risk management strategy because these guys have continued to produce really good returns and they've made many, many people who work at them immensely rich. So why would you question it? Well, you question it because you're using someone else's liquidity. You're using someone else's bid as your risk management. And once again, if they're all trying to sell, these organizations have, hundreds of billions of dollars at play at any one time. Yeah, now they're very diversified, but they're kind of all doing the same thing. So it's another thing that could just destabilize the market. So in terms of volatility trends, yeah, sure, the actual volatility in markets is low, but those 3 days in April should have led everyone to think there may be something fundamentally flawed in the way modern liquidity is working in the stock market. We're at all-time highs again. What is the risk? Now, right now, most people would say, it's zero, right? Things are fine, right? But we're like, and once again, we're not saying, no, the sky's going to fall in, everyone's going to lose all their money, everything's terrible. Clearly, things are going pretty well. The US economy is reasonably strong. Haven't gone into recession. Everyone keeps calling for it. It doesn't happen. Unemployment's at 4.1%. Inflation's not quite back at 2, but it's ahead. It's not too far ahead. Overall things look pretty good. Market's at an all-time high. All right, everything's great. But what are the risks that something comes from the left field and punches the market, either a physical event or just an endogenous, run on the market? I think the chances are much higher than people are imagining. So, in terms of, you asked me before, what do we see about that looks like 2008? It's this risk that you could have everyone all on one side.
Well, great. Well, this has been a fabulous interview. I've learned a great deal. We're at the end of our time. How best for listeners to get back in touch with you?
Well, we have a website. We're a Vulpes Investment Management, and we have some very bright people who will be delighted to engage with any questions people have. And, we're around. And look, seriously, we'd love to hear from people. We learn a great deal from other investors. We certainly learn more from other investors than we do from each other, because, there's always a risk. We're all preaching to the converted. So, no, we generally do welcome questions. Abuse, not so much, Paul, but questions, yes, always delighted.
Great. Well, we'll put your contact details in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
All right. Thanks, Hall. Great talking to you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.